I want to tell you about a woman named Roberta. Roberta is 74 years old. She lives in a nice suburb of Adelaide. She raised three kids, worked her whole life, and did everything right. She and her husband owned a home, paid it off, and when he passed, she kept going. Quietly, independently, the way her generation does. Her youngest son, Daniel, lovely bloke, genuinely loves his mum, came to her 2 years ago. He was starting a small business. He needed a hand, just temporarily. A loan, he said, just to get through the first year. Roberta gave him $80,000. She didn't tell Centrelink. Why would she? It was a loan. To her own son. It was going to come back. 12 months later, a Centrelink letter arrived. And when I tell you what that letter said, I want you to really hear this. It said Roberta had been overpaid $14,200 in age pension, and they wanted it back. All of it. Daniel's loan? Centrelink didn't see a loan. They saw a gift. And gifts have rules in this country that most Australians, and most of their adult children, have never once been told about. Today, I'm going to walk you through those rules, because what happened to Roberta is happening in households all over Australia right now, and the person causing the damage almost always loves you. Stay with me, because this one is going to matter. My name is your name, and this channel exists because I got sick of watching good, honest Australian seniors get burned by rules they were never taught. I'm not a lawyer. I'm not a financial advisor. I'm someone who has sat at enough kitchen tables with enough worried people to know that the complicated stuff can be explained simply, and that when it is, people can actually protect themselves. If you're new here, welcome. Hit subscribe and stay with me, because what I cover on this channel is the stuff that doesn't get explained at the Centrelink counter. And if you've got a parent over 65 watching this with you, or you're planning to share this with someone later, good, because today's topic is one that needs two sets of ears, yours and your kids. Right, let's get into it. Here is the rule that Roberta didn't know, and that Daniel didn't know, and that, I'd bet, most of your adult children don't know either. Centrelink has what's called a gifting limit. As a pensioner, you are allowed to give away up to $10,000 in any single financial year, and no more than $30,000 over any rolling 5-year period. Those are your limits. Full stop. Now here's where it gets important. If you give away more than that, whether it's to your kids, your grandkids, a charity, anyone, Centrelink does not simply look the other way. They call the excess amount a deprived asset. What that means in plain English is this: they assume you still have that money. They keep it in your asset and income calculations for 5 years, even though the money is gone, even though your son has it, even though you can't get it back. So in Roberta's case, that $80,000 she gave Daniel, Centrelink looked at that and said, "You have $70,000 in excess gifts. We're going to treat that $70,000 as if you're still sitting on it, and your pension is going to be reduced accordingly. For 5 years, I want to repeat that. You give the money away. The money is gone. But for Centrelink's purposes, it still counts against you for 5 full years. That is the rule. And it doesn't matter if it was a loan. It doesn't matter if there's a written agreement. If you gave the money and it left your account, Centrelink starts its clock. Now, does that mean you can never help your kids? Of course not. I'm not here to tell you what to do with your own money, but I am here to tell you that when you do it, you need to tell Centrelink, and you need to understand what it's going to cost you before you do it, because not knowing is not a defense, and your kids not knowing doesn't protect you either. Now, I know what some of you are thinking right now. You're thinking, okay, gifting, I've heard a bit about that, but my situation is different. We didn't call it a gift. It's a loan. There's an agreement. Stay right there, because I'm about to explain why a loan can be just as dangerous as a gift if you don't handle it correctly. And then I'm going to tell you about 3 other ways your kids can accidentally harm your pension that have nothing to do with gifting at all. These ones surprised me when I first learned them, and I think they're going to surprise you too. Let's talk about loans, because this is where a lot of families think they've been clever. Here's what people assume: if I lend my daughter money and she signs a piece of paper saying she'll pay it back, Centrelink has to recognize it as a loan, not a gift, so it doesn't count. Here's the truth: if that loan is properly documented, with a signed loan agreement, a specified interest rate at least equal to the Centrelink deeming rate, and structured repayments actually being made, then yes, Centrelink may treat it as a financial asset rather than a gift. But, and this is a big but, it still counts as an asset. The money you lent is counted as money you have, because technically you have a legal claim to it. So your assets test doesn't go down just because the cash left your account. It's now sitting there as a receivable, and if those repayments aren't being made, if the interest isn't being paid, Centrelink can and does reclassify that loan as a gift at any time. And suddenly you're back to square one, 5 years of deprivation counting against you. The paperwork matters, the repayments matter. And frankly, if your child can't make the repayments, which is often why they needed the money in the first place, you are in a very difficult position. This is why I always say, before you lend money to family, talk to a financial advisor who understands the pension rules, not your son in law who works in real estate, a specialist, because the cost of getting this wrong is not a slap on the wrist. For many pensioners, it's years of reduced income. Now, let me take you through the three other ways this can go wrong, and these ones are the ones that really catch people off guard. The first one is moving in with your kids. More and more Australian seniors are moving in with their adult children. The arrangement makes sense: company, care, lower costs. But many families structure this in a way that triggers massive Centrelink consequences. Here's the scenario: your daughter says, "Mum, come live with us. We'll build a granny flat out the back. Contribute $150,000 toward the build, and you can live here for the rest of your life." That $150,000 you contribute, Centrelink calls that a granny flat interest, and the rules around how they assess it are complicated and sometimes brutal, depending on how the arrangement is structured. In some cases, Centrelink assesses the full amount as a deprived asset. In others, they apply a formula based on your life expectancy. The point is this: if you haven't talked to Services Australia before you sign anything or transfer any money, you may be walking into a trap that costs you pension income for years. The fix is simple: call Centrelink or see a financial advisor before you do anything. The arrangement can be structured properly, but it must be done before the money moves. Once it moves, the rules lock in. The second way is paying for your family's everyday expenses. This one catches people completely off guard: paying for grandkids' school fees, covering your son's mortgage for a few months when he lost his job, picking up the grocery bill for the whole family every week. These aren't loans, they're not formal gifts, they're just a grandparent being generous, being a parent. But if the total of those regular payments exceeds that $10,000 annual gifting limit, Centrelink treats the excess exactly the same as any other gift. Every dollar above the threshold becomes a deprived asset and starts that 5 year clock. The hard reality is that some pensioners are quietly subsidizing their children's households to a degree that would stagger them if they added it all up. And not one of them thinks of it as gifting, because it doesn't feel like gifting. It feels like love. But Centrelink doesn't count love, it counts dollars. The third way is putting your child's name on your assets. This is becoming more common. Families who want to simplify estate planning or protect assets from aged care costs add an adult child's name to a property title or a bank account. The moment you do that, the moment that asset is jointly owned, Centrelink wants to understand the full arrangement, and depending on how it's structured, you may trigger a reassessment of your assets test. There are also potential stamp duty and capital gains tax consequences that your child may not have been told about. And in the worst cases, if that child later goes through a divorce or a bankruptcy, your home could be caught up in it. I'm not saying these arrangements are always wrong. I'm saying they need to be done with proper legal and financial advice, not on a handshake at Christmas dinner, right? So we've covered the problem. Let me give you the practical steps because I never want to leave you with just a worry and no way forward. Step one, have the conversation with your kids, not a scary conversation, not an accusation, just this. I need us both to understand the Centrelink rules around gifting because I don't want either of us to accidentally create a problem. Most adult children have absolutely no idea these rules exist. They're not being careless, they just don't know. Once they do, they can be your first line of defense. Step 2, track every dollar you give. If you're helping your kids financially, keep a running total. Know where you are relative to that $10,000 annual limit. A simple notebook is enough. You don't need anything fancy, you just need a number you can look at. Step 3, before any large financial decision involving family, call Centrelink's Financial Information Service. It is free. The number is 132-300. Tell them what you're planning to do and ask what the pension consequences would be. They will tell you. That is literally what the service is there for. Step 4. For anything complex, a granny flat arrangement, a large loan, adding someone to a title, see a licensed financial advisor who specializes in aged care and pension rules. The consultation fee is almost always less than the cost of getting it wrong. Step 5. If you've already done something and you're not sure whether it was reported correctly, call Centrelink. Voluntary disclosure almost always results in a better outcome than waiting to be found out. The system is not designed to punish honest mistakes made in good faith. It is designed to catch deliberate hiding. And you are not hiding. You just didn't know. Now I want to finish with something that has nothing to do with rules or numbers. The families I've seen get hurt by this, the Robertas of this country, they weren't careless. They weren't naive. They were just doing what parents do, putting their kids first, quietly, without making a fuss about it. That instinct to help your children, to show up for them the way you always have, that is not a flaw. That is who you are. And it's part of what makes this generation of Australian seniors so remarkable. But the system doesn't know your heart. It only knows your transactions. And so the best thing you can do for the people you love is to understand these rules, protect your income, and stay financially stable. Because a parent who is secure and independent is a far greater gift to their children than $80,000 that ends up costing everyone dearly. Roberta, by the way, she sorted it out. It took time. It took a lot of stressful phone calls, but she got there. And Daniel now understands these rules better than most people I know. That's the silver lining in all of this. Once your family knows, once everyone is on the same page, you become a team, and that is a much better place to be. If this video helped you, if it answered something you've been quietly wondering about, please hit the like button before you go. It's a small thing, but it genuinely helps this channel reach other Australians who need exactly this kind of information. Subscribe if you haven't already, and hit the bell so you don't miss what's coming next. Because in the next video, I'm going to walk you through what actually happens when Centrelink decides to review your file, what triggers it, what your rights are, and exactly what to say when they call. And please, share this video. Send it to your kids. Send it to your sister. Send it to that friend who just retired and has no idea any of this exists. One share could genuinely save someone you care about a significant amount of money and a whole lot of stress. I'll see you in the next one.